All right, so as you probably know by now, I am pretty technically oriented with my trading, right? So this isn't necessarily about trading. This is about how to analyze bigger picture stuff, right? There is a natural order in the financial markets, or not necessarily now, because everything kind of trends together in, credit contraction and credit expansionary mode, but it'll return at some point, and I'm going to go through kind of the natural order of markets and what bonds can tell you about stocks and stocks tell you about commodities, and also give you, some indices that you might want to follow that tend to be leaders, okay, for the stock market in general. And obviously, these days, it's important to know what the stock market's doing if you're trading currencies, because it is highly correlated. The dollar, right, is inversely correlated to the Dow and the S&P, and has been for a couple of years. So until it stops working, we might as well continue to follow that model. All right. The risk disclaimer, seen a lot of these, I'm sure, and I don't think I have to read it again, but this is not to be taken lightly, of course. You can lose just as much as, if not more than you have, so please consider your financial situation and only trade with risk capital, of course, before you attempt to trade. All right, so we'll go through typical asset rotation, and what I mean by that is, in general, how bonds rotate, with stocks and commodities. Okay, bonds do tend to lead. You may have heard, although again, not so much now, but you may have heard over the several years that the bonds are the smarter market. Okay, bonds tend to lead and tell you where you're going. Generating signals with stock market indicators, we have a lot more data to work with the stock market. Okay, we've got volume, we have advanced decline ratios, and we can make indicators from those that equity traders do. Okay, and so considering the correlation between, say, the Australian dollar and the stock market, I like to trade the Australian dollar, partly because of that. I have more information at my disposal, and I can get signals from the stock market to trade the Australian dollar. So I'll show you how you can do that. Interest rate differentials. I publish interest rate differentials, and not necessarily the absolute interest rate differential. That's not what is important. It's the trend in the interest rate differential that's important. And these are published every week, Daily FX, under the technical portal. So typically you see the interest rate differential turn up with price, but sometimes it will turn up ahead of price. And it did happen last year at the 2010 low for the euro dollar. A chart of interest rate differentials will show you that we turned up about a month before the euro, and the euro plummeted. So in order to find out when you're diverging, okay, from price trend, maybe diverging from interest rate trend, I have an indicator I've created that measures that. And when it gets out of whack, we get a signal to buy or sell. Okay, so three major asset classes, right? Stocks, bonds, and commodities. And typically the dollar moves inversely to commodities because commodities are priced in US dollars, okay? So the typical asset rotation of these for a long time looks like this, all right? But really since 1998, things have been kind of out of whack because for the first time really since the 1930s, you've had deflationary forces. So this market cycle is more descriptive of a disinflationary or an inflationary environment. And think of why bonds may lead stocks, though, which may then lead commodities. Okay, typically, bonds, the price of money, right? As bonds go down, yields increase. Okay, as yields increase, it costs more to service debt. It costs more to buy things. Companies then feel that in their bottom line. So as yields are increasing, which means bonds are decreasing, you have a top in the equity market as earnings get hit. Okay, there's actual reasons for why these happen. I like to see it in action, of course. And then finally, the resource-driven sector will top out last, okay? And here's just some examples. This is going back to the 1980s. And the top, you have bonds. In the middle, you have the S&P. On the bottom, you have the CRB commodity index, okay? So you can see here the 1981 low in bonds does precede the 1982 low in stocks by about a year, okay? The June 1986 top does precede the 87 crash by about a year. Now, I have that circle of circled areas there, okay? Those were tops that occurred in the bond market, but there really were no corresponding tops in the stock market. So just because you have a top in the bond market does not mean you have to have a top in the stock market, but there never has been a major top in the stock market without a preceding top in the bond market. So that's important to note, okay? So the next example, which would be 1996, we did have a top in the bond market. Again, no top in the stock market. The 90s were just insane, right? Stocks went through the roof. But we did have a top about a year later in the commodities market. 1998 preceded the 2000 top with a bit more lag, right, over a year. And these are big picture things, which then preceded the commodities market top by about 8 months. Tops in the bonds in July of 05 and December of 06 preceded the biggest top we've ever had, which was, right next to the 29 top, I guess, which was the October 2007 top, okay? And again, about a year, a little less than a year from December of 06. And that, of course, preceded the commodity top, which was a year later. This was also the turn in the dollar. You remember the euro topped out at 160 in the summer of 2008, as did the Australian dollar, and everything else for that matter. And then getting a little more recent history, this relationship has still held. Remember I said it's important that we've never had a top in the stock market without a top in the bond market about a year before it. Well, we did have a top in the bond market in August of 2010. We have gone on to new highs since then, as yields have plummeted to record lows. But sure enough, we had the most recent top in the stock market was on April 11th. So this was used in real research recently to say that things are getting vulnerable because bonds topped, therefore we should look for a top in stocks. The timing's difficult because this is a very long-term chart. This is a monthly picture. But it's important to note, and it helps you know that you probably shouldn't be very bullish because bonds topped about a year ago and we're at risk. And of course, as things have trended together, the recent top in the CRB index was pretty much the day of the top in the stock index, the S&P and the Dow and so on. So if you saw this morning, the CRB index, that top was right at the 61.8 retracement of the decline from the 08 high. Okay? All right. So the CRB index and the S&P index have indeed tended to move in unison, okay, for the last several years. Okay? And again, that can be because deflationary forces have disrupted the balance, okay? Credit expands, contracts, and everything seems to go up together and down together. All right? You can, however, find market divergences, intermarket divergences, where stocks reached a new high, okay, last May, and the CRB commodity index did not, okay? And at the low that corresponded, we got a new low in the stocks. We did not get a new low in the CRB commodity index. So it's important to keep all of these, you don't have to look at them every day, but you might want to look at them every week and say, what commodities do this week? Are commodities at a new low? Say, right now, okay, equities are testing lows, okay, that were made in August. We're getting pretty close. In fact, S&P Globex session just opened up. We're down to like 11 points, so we're getting close to the lows. If we break those lows hard, watch and see where the CRB index is at. Maybe it doesn't break its August low. If it doesn't, you might have a divergence that may indicate a bottom, okay? This is just hypothetical. I'm just giving you examples of what may happen. My gut feeling would tell me that we probably would break to new lows in commodities if the equities did break as well, because it just, we feel like we're breaking and everything's going to, what. Okay, market cycles review. Again, this is secular trends. These are big trends, all right? But typically, stocks lag bonds by about 12 to 18 months, okay? This is not a trading signal or a mechanical signal or anything like that. This is how to understand big picture, what's going on in the market. Did we have a top in bonds last year? If we did, then we should probably look for a top in stocks. Okay? If you're a big bear on stocks and we haven't had a top in bonds, then you should probably review your situation. Okay? Commodities do tend to lag the equity markets. The timing's a little different. Recently, there has been no timing. They've been at the exact same time, right? As long as that continues, until all the excess credit's washed out of the system, this is going to continue. All prices are going to continue to rally and decline together. And this will be useful for the Aussie dollar in particular, which we'll get to. Okay. Inflation, deflation shifts. You may want to keep, I wrote down a few indexes that you may want to follow, okay? Because the stock market in particular, there are leading sectors and lagging sectors. Leading sectors would include your interest rate sensitive areas, which would make sense considering that bonds do top ahead of stocks, right? So utilities, financials, REITs. Utilities, global utilities S&P index is SGUY. And then the global financials is SGFY. Lagging, you want to look at energy, which is SGEY. And the materials index is SGMY. Here's examples for global energy, global utilities. We have kind of an inflation-deflation index here, right? We got the S&P regular on the top, the energy sector in the middle, utilities would be your deflation or your leading index on the bottom. You can see that at the tops, in 2007, kind of stocks topped, utilities topped, right? The energy sector went on to new highs, right? Commodities tend to top out later. Well, a commodity index, energy is a commodity, tops out later, okay? But look, global utilities did not make a new high. They're leading on the downside, much like financials did, which we'll see here. And then a little closer to home, recently in April, you can see utilities not even getting past their highs that were made in 2010, yet energy was at a new high, okay? We were topping. This was just a few months ago. So this picture is quite bearish for the current situation and where we're going, okay? Again, same thing, energy and financials. Financials especially have been leading on the bottom. And, financials an interest rate sensitive index, okay? This is just an index, so it's energy divided by utilities. It kind of accentuates the point that utilities will top out ahead of energy, and when you get a divergence like that, it's bearish for the overall market. You can see here, in the energy utilities index, the Aussie dollar makes a new top. That's an intermarket divergence, okay? Same thing recently. We had energy utilities index topping out, okay, ahead of the very slight new high we had in the Aussie. This was just 1 month ago in August, all right? So this is applicable to the current situation. Now, if, for example, that energy index, energy divided by utilities, was going on to new fresh highs, you would not want to try to trade an Aussie dollar reversal. It would tell you that risk sentiment is well and on, and we're probably going higher. Okay, so risk on, risk off, let's be honest. It pretty much is one trade everywhere, right? Interest rate differentials will determine whether it's a risk on asset or a risk off asset. The higher interest rate differentials are between the Aussie dollar, the New Zealand dollar, for example, but pretty much the Aussie dollar. And then your low rates are your yen, your Swiss, although I don't like messing with either of them because of the intervention problems and the risk that raises, being caught on the wrong side of a move on either direction. So I stick with the US dollar. But in general, okay, stock market rallying, risk on, you're long the Aussie. Stock market falling, short carry, you're short the Aussie. It's really that simple right now, okay? So here's what the 10-year yield and the S&P index show us. The 10-year yield, again, bonds lead, okay? So, you hear people pundits on TV, and they talk about yields are so low, that's great for the consumer, refinance your house, blah, blah, blah. This is actually pretty terrible for the economy, okay? Think of the yield, U.S. bond, the interest you get paid, okay, as a dividend paid out by U.S. growth, all right? If the yield on the 10-year is at 1, or wherever we are right now, we've fallen even lower, then there is no U.S. growth. So it's probably not a good idea to be long carry. And the stock market's going to reflect that at some point. So you can see how bonds have continued to fall with stocks throughout the 2008-2009 process, but you do get intermarket divergences. At the 2009 bottom, you had a really good one. Okay, stocks fell to a new low. 2009, yields were a little higher, telling you things might not be as bad as everyone thinks. All right, and then at the recent top, stocks were higher. Okay, everyone was really happy and making money on the long side, but the 10-year yield was not at a new high, telling you that no, there is no U.S. growth. Okay, the dividend yield's not going up. I'm not saying it's not a dividend yield, but I'm just comparing it to that, right? Okay, tops in the 10-year yield in the Aussie yen. This is like the pure carry instrument, right? You can see, notably, the collapse that we had start in 2008. Okay, that was along with the Aussie yen. Since then, the Aussie yen has made slightly higher highs, okay, while the 10-year yield has made lower lows. We have that intermarket divergence again. This is really bearish for carry, okay, going forward. It's a good time to do this presentation because this is applicable to the current situation, okay? You have 10-year yields crashing through to the lows they saw in 2009, all right? The Aussie yen's held up pretty well. This chart, if it was updated as per last Friday's price action, we would be lower, but not all that much lower. So what this is telling you is that the 10-year yield, testing 2009 lows, Aussie yen may follow it. If it does, then we're going to be 2,000 pips lower, okay? I can't say when, because I don't know, and I might not even be right. But I'm saying there's an opportunity here, and it's, to follow the bonds. The bonds are telling you, the smarter market's telling you that U.S. growth is terrible, world growth is terrible, no one, people want cash and safety, and owning the Aussie yen is probably not a good idea. All right, so the soft assets versus hard assets. There's always an asset bubble somewhere, it seems, right? And soft assets are your banks, stocks, bonds, okay? Hard assets are commodities, gold, silver, copper, what have you. So these things are always moving in a cycle. Throughout the 90s, the 80s, it was hard or soft assets that dominated, bonds and stocks, okay? Throughout, basically since 2000, it's been hard assets, gold, silver, and, commodities in general, for that matter. Okay, now, since 2008, we've kind of topped in both of them. And again, this is the deflationary scenario at work, to different market environment. But I'm going to show you a ratio which I think is very interesting and may indicate a shift in the horizon longer term with what's going on as, Aussie has rallied so much in the last 10 years, okay? So here's a gold Dow ratio, okay? You got gold on the top, and it's the gold line. The S&P in the top and the black line. And in the bottom, you have the gold divided by Dow, all right? Now, throughout the 80s and 90s, gold fell against the Dow, right? Soft assets dominated. Since 2000, gold rallied, okay, against the Dow. And how would I, in real time, figure out if it's in an uptrend or a downtrend? You see how it's red and blue when it turns up? That just means that we're at a 36-month low if it's red, and we reach a 36-month high if it's blue. So that's a breakout, okay? It's a very long-term breakout, albeit, but you see how smooth the trend is, okay? It's telling us maybe downtrend. We're in, hard, sell hard assets, buy soft assets, which in the currency world would be buy things like the British pound, buy things like the U.S. dollar. Those are where the banking centers are, okay? Sell things like the Australian dollar, the Canadian dollar. When we turn up, buy things like the Australian dollar and the Canadian dollar. The resource currencies, sell the British pound, okay? Which is, your banking center in London, U.S. dollar, New York, and so on and so forth. The dollar has a lot more things to worry about, but you get the general idea, okay? So you can see where we are now. We've almost, not quite, but we've retraced a very large portion of the entire decline from the early 80s in this ratio. There are implications right now. If we go a step further and put RSI on that ratio, okay, this is what it looked like at the bottom in 2000. We had that deeply oversold condition. Okay, we're putting RSI on a ratio right now, so we're getting very technical in our macro outlook here. But you can see, in general, the Aussie-pound exchange rate, which fluctuated a lot more wildly, but its trend was the same, okay? So by using a ratio, which is much smoother, okay, the gold divided by Dow, we have a downtrend, and we're looking to sell the rallies in the Aussie-pound exchange rate, which is much more volatile, okay? The same thing on the upside. So look at where we are right now compared to where we were 10 years ago. It's almost the exact opposite situation, right? We have a deeply oversold condition 10 years ago, yet with slight divergence, okay? We go into a basing pattern, so it took a while to form a low, then we went higher. That would have been, Aussie dollar time, which, has gone up like 40% in the last 10 years. We have now the exact opposite situation. We have an overbought condition, but it's also divergent. So this may warn that gold, at least in terms of stocks, would be maybe turning over a little bit. It kind of goes against mainstream right now, of course. To this point, we may be on the verge of a very exciting move in gold, okay? And and commodities in general, what kind of influence would that have on the Australian dollar? Probably not bullish, right? And I don't have the chart up and I don't have live charts here, but if I did, you would see that right now the gold divided by Dow ratio actually has a head and shoulders pattern on it that's been forming for the last several months. And it's funny because that follows exactly the head and shoulders pattern in the actual Dow, right? Okay, so just since that signal in which we had a 36-month high in the hard versus soft ratio, okay, or actually the gold divided by Dow ratio, which again is our hard-soft ratio. This is the currencies, and this is the futures contracts, continuous futures contracts. This is the percentage moves. Okay, so it's not necessarily against the U.S. dollar, but the Australian dollar, you can see the biggest gainer. Then Swiss, that number would be a lot different right now because I did this slide before the SNB peg to the euro. Then the euro CAD. Pound, which again, the banking center, we would expect to be towards the lower end. And the yen, okay? The yen's at record highs, but you got to remember 10 years ago, and it was fairly high as well, okay? Okay, intricacies. These are things to watch and to give you an idea, specific ideas. If one market's doing one thing, what does another market tend to respond? The yen tends to line up with U.S. Treasuries, right? It's a carry trade vehicle, much like it's indicative of the amount of risk, that tolerance that's in the system. So as yields go up, dollar yen goes up. As yields go down, dollar yen goes down. We've seen it kind of diverge a little bit as yields have continued to plummet. The dollar yen hasn't really gone anywhere, right? So maybe we'll get a delayed reaction, who knows? Okay, and obviously the Aussie and the Kiwi do lag the S&P a little bit over the last couple of years by 1 week. You'll see what I mean. Okay, so here on the top is the 10-year, and on the bottom is Japanese yen futures contract. The reason I plotted it this way rather than dollar yen is so that you wouldn't have to envision the inverse of the yen, right? You're getting the actual yen. So you flip over this yen chart on the bottom, it would be dollar yen, okay? And you can see that the tops and bottoms do line up quite well. One useful application here would be to look at this chart, say, after every day or every week, and see if you have a new high confirmed by a new low or not in yen, in treasuries. And that would get, if say you have a new high in treasuries but not in yen, that might be a divergence. Or say you have a new high in the yen and not in treasuries, you might have a divergence. Okay, and then we have the S&P on the top, Aussie in the middle, Kiwi in the bottom, and this is a weekly chart. And you can see these tops in the stock market. On several occasions, you've actually had the Aussie hold up for a few more weeks, okay, before topping. So this is quite useful, all right? Now, the recent top was actually pretty much right on. You can see here, the recent top, the Aussie top a little bit prior, but tops before that, okay, you had right on. The one before that in October, you had the top in the equity market, and Aussie and Kiwi topped 1 week later. So it's something to watch. And this is the recent one, and the equity market started tanking. You can see on July 22nd, that was the top. Well, the Aussie and Kiwi continued for 1 more week, and then they fell off a cliff. And combining this with all the other information from that I use from a trading perspective is how you get a trade. Okay, so this, and then you've done all your analysis, like on the RSI and the stuff I presented earlier, and then you know that if there's going to be a reversal, it usually occurs at the beginning of the next month, right? Well, sure enough, the Aussie and Kiwi held up because they do tend to hold up their trend for the rest of the month, and then reversed, right? In the beginning of August, the first trading day of August is when they made their top. Okay, stock market indicators. Volume and ARMS, or TRIN. This is the, Richard Arms was a man who invented this indicator, and this is the equation for it. But it just advances divided by declines, divided by the ratio of volume. So this really is dominated by the denominator, okay? If you have a huge amount of down volume, then you're going to have a very small denominator, and therefore you're going to have a very big number, right? Divide something by a very small number, and you get a big number. Because it's the same as multiplying it by a very big number. So it's best used to signal panic lows, and the behavior of prices and panics tend to end quicker and more sharply than do tops, okay, which are complacent and take a while to form. Right? You crawl higher and then you go. But this is what volume would look like on a weekly chart. If you're just looking at the highest volume in 13 weeks, this is what it looks like in the S&P and the Aussie dollar. Tends to mark lows, okay? Not every single one, but some of them, or most of them, I should say. And this is, again, this is TRIN on the bottom. So you're probably wondering, where can I get this indicator? I get it from the TradeStation terminal. I used to be able to get it on Bloomberg.com. I can't find it there anymore. I think they took it off. But for your purposes, whenever there is a high 20-day reading in TRIN, which is what this is, I always talk about it in the video I put out every day after the New York close. So, usually release that video around 6 to 7 o'clock p.m. Always talk about TRIN. I usually open up the video talking about the stock market in general because it so influences the trends in the currency markets and vice versa. But again, we have more data to work with the stock market, like volume, like TRIN. Okay, so a simple TRIN strategy, long when TRIN is the highest in 20 days and exit 10 days later. And this is what TRIN looks like, the highest in 20 days. You get these spikes. Now, I will say that we had the highest TRIN in 20 days on Friday, okay? So we may, we're at risk of a turn to the upside. I'm bearish, but have your stops in place. You should always have stops anyway, but because of that extreme reading in TRIN, you definitely want to have stops in. In fact, it was the highest reading that we had since July of last year, of 2010. What happened in July of 2010 was we went lower, but just a little lower for about 3 more days, and then we turned higher, okay? Okay, and this was tested from December 99 until basically now, and that's what the strategy looks like. So you can see it got killed during the 2008 collapse because that's when TRIN's going to be really high every day, and you're going to have huge volume every day, and the market's just going to collapse. But that's what a collapse does. Everything just collapses, it falls. So buying anything would be a detriment, obviously, and would wipe out your account. Since then, spike bottoms have been just that, spike bottoms. They've given away to reversals. This obviously is not going to work forever. In fact, looking at this right now, it's so ridiculous, the straight line, strategy, that I think it's probably doomed to fail soon. So maybe the signal we got on Friday, the high 20-day trend, will be a bad signal. I hope it is, because I'm short the Australian dollar, of course. So no, but seriously, you see an equity curve like this, it's not going to go on forever. It just doesn't work that way, right? So at some point, it will give way to something like we saw there, in the 2007-2008 period, and that collapse in which the equity drawdown was 100% more. Okay, it was actually from 10 to negative 10,000. And then after that, we may have opportunities to trade the strategy again, but it's just too good right now. Okay, getting to the interest rates. Trends in interest rates. Money does flock to the highest returns. It's just the nature of money, right? Change in differential is most important. And money flocks to the highest return, okay, even in periods of stress, okay, 2008, 2009 come to example, right now comes to example. Okay, you say, well, that's not true. Money's going to treasuries, which doesn't yield anything, right? No, it doesn't, but the money that it's coming from is coming from currencies that have their interest rate falling at a faster rate of change than the US dollar interest rate. Here's the euro dollar and its interest rate differential. Pretty highly correlated, right? And on the bottom, you can see the two yields, euro yield, US yield, just euro generic government yield. That's what that is. And you can see for the most part that they do trend together. There are some instances when the yield differential bottoms before the actual exchange rate. Most notably, we had that in 2010 at the low. You can see the blue line. It's about 2 weeks before the actual exchange rate bottom. If you remember, the euro kind of went right into its June low, 118 something, and then reversed, 118.75, and then had that very sharp reversal. What's very interesting to note recently is that you had the interest rate differential continue higher, and the euro could not break 145, okay? Sure enough, since then, if I were to update these charts, you would obviously see the euro at about 1,000 pips lower, and the interest rate differential would also be off quite substantially. Okay, so interest rate indicator, again, it's the differential in the price trend and the interest rate trend. I publish this indicator for all the dollar pairs, as well as the euro yen and euro pound, every Friday. If you just go to dailyfx.com, it's at the top. Technical articles, okay? Click on technical, then click on articles, and then it's under there, and it's called FX Technical Weekly, and it'll have a different title every week, but you'll be able to find it. And again, always remember, money chases yield, okay? So here's some examples, and so you know how to read the report. The bottom indicator is, again, it's indexed. So what that means is that it's going to move between, it can never go above 100 or below a negative 100, but it never gets that high or that low anyway. But what you have is the difference in trend and the difference in price indexed and subtracted from each other. So if price trend is going through the roof and if interest rate trend is not, then you're going to have a very low reading, and it's going to indicate that you're out of whack, okay? A very high reading is going to occur at bottoms. So the dots on the charts, okay, the small ones are when you're at a 13-week high or low in the indicator, and the dark ones are when you're at a 52-week high or low, and those are reversal signals, okay? So you can see it tends to work okay. It's just another thing I use to understand the probability that you may or may not reverse, of course. These are not mechanical trading signals. They shouldn't be treated as such, okay? But they do add to my, my information toolbox. If I see that we have the highest interest rate differential disparity between price trend and interest rate trend, okay, in 52 weeks, and I also have an RSI divergence, and we're also going to the beginning of a new month, then I might go short, okay? Okay, a little analysis on the US dollar and the yield curve. When you hear long end, short end of the yield curve, long end is going to mean, 30-year, 10-year. Okay, short end is reflective of Fed policy. That's your really short-term debt. So, 3-month overnight rates, even a year or less is short-term debt. Okay, anything over that is pretty much long-term. But one way to look at the yield curve on a basis over time is to subtract the difference between 2-year yields and 10-year yields. Okay, so the 10-year minus the 2-year. So if this is falling, you have a flattening curve. Okay, if If it's rallying, you have a sharpening curve, okay? So, or an increasing curve, I should say. Now, recently, the dollar has tended to do well, okay, as we've had a flattening curve, okay? And that's happening right now, okay? You can see all during the 90s, late 90s, we had a flattening curve and the dollar did okay. For the most part, you can see the 2008 panic rally, and this is a monthly chart, so you gotta have to look, that rally off of the low was accompanied by a sharp flattening, and then we went back to record, record highs, okay, in the difference. But the implications about us falling now, okay, is dollar bullish. Okay, now there's many arguments for why it is or why it isn't and what could happen. But again, I'm just looking at this as a technician, from a technician's point of view, and saying that in history, recent history, okay, a falling yield curve, flattening yield curve has tended to be dollar bullish, especially in times of, of duress. And that's what we got. You like that guy? All right. Well, thank you so much for coming to the FXCM Expo.